Welcome to our panel, What's Next in Real Estate ESG. I'm Mary Hogan Preusse. I'm a senior advisor to fifthwall. I come from the old world of real estate, like bricks and mortar, where a lot of the people there are just waiting for things to go back the way they were. I sit on a bunch of corporate boards. I was a REIT investor for a long time, and it's so wonderful to be associated with fifthwall to really understand a lot more what people are going to have to dealing with in the future and what really is finite. So I'm really delighted to be here. And we have an amazing group of people up here with me today. To my right is Heather McGeory. She is the head of sustainability at fifthwall, my colleague, where she focuses on ESG and decarbonization strategies across fifthwall funds. Prior to joining fifthwall, Heather was the global practice lead on climate at APCO, a public affairs consultancy, and also served as the chief operating officer and co-founder of the We Mean Business Coalition. Next to her is Rob Simpson. Rob is the Senior Director of Sustainable Investment and Head of Climate Change Strategy for Ivanhoé, Cambridge. Rob's focus is on decarbonization of a global portfolio of properties across multiple asset classes, and he also oversees Ivanhoé's strategic approach to climate risk. And so it's great to have that investor perspective up here today. Next up is Natalie Teear. Natalie is the Senior Vice President of Innovation, Sustainability, and Social Impact at Hudson Pacific Properties, a West Coast office and movie studio REIT focused on serving dynamic technology and media tenants, including Amazon, Google, and Netflix. And I just wanted to say to my fellow panelists, don't ask her about the office market. Don't ask her about the writer's strike. Let's just stay in a different place. We'll stay in our happy ESG place. Thank you. And then last but not least, we have Michael Gulich, and I apologize, this one's in a really small font. Michael is the Vice President of ESG reporting at MGM International. He leads the development and execution of strategies to reduce the environmental impact of MGM's resorts, buildings, operations, and events globally. So that is us. So I'm going to kick it off today asking the first question about, what's next in real estate ESG. When we were brainstorming for this panel, I was quite surprised to find out that what was next for ESG on the minds of many of these panelists is that there's not going to be ESG anymore, or it's not going to be named ESG. And Natalie's the one who brought that up. I don't know how you feel about the E and the S and the G.
Yeah, I think it will continue to exist. I just think the term's been used really liberally for a long time, and now there's a lot of confusion around it, and there's criticism from the left of, greenwashing ESG funds that aren't doing anything, and criticism from the right of it being a sign of woke capitalism. And so it's, I think there's going to be a cleanup exercise where people try to be more precise with their language. ESG has, and I think is always been intended to be an investor term. I think corporates like Hudson Pacific, I've always tried not to use it and use words like sustainability, social impact, innovation, words that reflect the actual initiatives that we're driving. And whether or not we have ESG-oriented investors who respond to that is kind of out of our control. So I think people will get more precise with their language. I also think there will be more of a focus on linking those initiatives to business value, especially in the this world we live in with the Supreme Court and the recent decision around affirmative action and the pushback for what that means for DEI programs. I think there's going to just be a real focus on making sure that the initiatives you're creating and how you're selling them, as long as you can tie it straight to business value, that seems like this in the all clear. But I think people will get more sophisticated in how they frame up those programs and talk about them.
Yeah, it does seem like they're linked together at the beginning because it was just three things that people needed to focus on, but they don't have much to do with each other anymore. Heather, did you have any thoughts on that about looking at the E and the S and the G?
Yeah, lots of thoughts. I always used to say, and still occasionally say, that this idea of ES and G lumped together is, I think the environmental and the social is kind of what we're doing, and the governance is how we're doing it. It's very hard to look at all of those things exactly on the same trajectory. But looking forward, I think we're actually in quite an interesting inflection point. I think, Natalie said this, ESG has never been a high-performing term to begin with. But we are now in this culture war, and just from January to July of this year, 156 pieces of anti-ESG legislation has come to 37 states, and 22 bills have passed in 14 states. And so I think we really need to get behind this idea that if we want to have the responsible business practices still part of what we're doing, we need to move away from the term ESG very fast. And I think the more that Vivek Ramaswamy is also more and more in the center of the conversation for the Republican presidential election, I think the more and more we're going to hear about it. The other thing that I'll say is the SEC is starting to subpoena investment managers who've been using the terms ESG for the last couple of years. I think ultimately they're there to protect investors. What's really positive about that is that we're getting to a place where we really need to define what we mean so that we can define what products we're investing in. And then just the last piece, just to go back to the anti-ESG legislation, is that what this legislation will do in many cases is to take away the ability for investors who are often investing on behalf of public service employees. So they will no longer be able to look at responsible business as a metric when they're making investment decisions. And so it's actually kind of cutting off information and transparency from investors being able to make decisions. So I think we're in an important moment where we need to really manage what's going on with ESG.
Yeah, I agree. Michael, it's in your title as well. What's it like at MGM, and what's the reaction you're hearing? Do you acknowledge the cultural war? Do you feel like it needs to be broken down issue by issue?
Yeah, I think it's in my title for better or for worse, right? So I think we're watching very carefully. I really think we're a values-based company, and we've got long-term goals that we're focused on. And maybe by design, there's a lot of overlap between what's good for business and what's good for society and the environment. And so I think we definitely we're definitely thinking about how we talk about things, and maybe focusing less on the metrics and more on articulating how these initiatives are good for business. And I think that the nuance and the storytelling is really important. So,
thanks. Rob, there's been a lot of, Larry Fink has, 10 bodyguards when he only needed 5. I think the backlash that some investors are hearing about their commitment to sustainability and responsibility, however you call it, it has been profound. What's it like at Ivanhoé, Cambridge? How's the mood and the receptivity?
Ivanhoé, for those that don't know, is a global investor that has assets across all major asset classes in about 15 countries, about 80 billion Canadian dollars as of the end of last December, end of 2022, under management. So we have a fairly wide view on what's happening globally. The ESG sort of discussion and the language specific to that tends to be more US-centric than what we're seeing in other markets. I'm based in Toronto, and Ivanhoé's head office is in Montreal. Even in the Canadian context, we see bits and pieces of it, but certainly not to the extent that we're seeing here. Largely, and I think this has been echoed already up here, we try to just ensure that we are demonstrating value. What's the impact of what we're doing? Very cognizant of avoiding greenwashing claims, not claiming to do things that we're not actually doing, tying everything to the value piece, how is this improving the asset value, avoiding stranding, et cetera, that we'll get into in a little bit more detail. But those are the areas that we focus on and tend to sort of leave the discussion around the term and the weaponization of the term and all of that to others. We kind of ignore the problem, and it tends to go away usually.
Yeah, it's interesting. I mean, I am an ESG person. I sit on boards, so governance is really important to me. Doing the right thing is really important to me. So the S, but I do think that the E side of it, the sustainability side of it, is so much more future forward than the other two. I don't know if any of you guys want to comment on that, about just how, how far in the future we have to look about this and how interesting it is.
Sure, I can start. Historically on the E side, we have really done, the typical stuff to make buildings more efficient, energy management, that kind of thing. It's all been great. It's all been, helpful in where we're going, but it hasn't been at the scale required to achieve what we really need to achieve around decarbonization and real improvement in the sector. And I think now realizing the amount of capital required to get us to where we need to go is forcing us to sort of think longer term, really position our portfolios, et cetera, through that lens, hence much more future looking in how we approach the E in particular. And there's lots of examples of that we can touch on through the course of the discussion.
Yeah, we're also a long-term holder, and we are also focused on the West Coast of the US major cities and big tech and media tenants. And so for us, it's always been really easy to link the E to business value. There's obviously the energy efficiency ROI value story that applies to every real estate asset class everywhere. But for us, there's a lot around differentiation and renewables and rent premiums, and it's really hard to prove. Does a LEED certified building get a higher rent than a non-LEED building? Because usually the LEED ones are the nicer modern buildings anyway. But anecdotally, we are 100% believe that is the case. 90% of our portfolio is LEED certified because we want to signal to tenants in particular, and somewhat to investors, but mostly to our tenants who want sustainability, they care about it. And so for us, that's an easy way for us to signal that we're committed to it and we've invested the necessary resources.
I'll just add that I think taking the long view levels out some of the turbulence we're just talking about around ESG. But also when you think about some of the facilities and the life cycle of the assets we're talking about, whether you're heating air or heating water, sort of the worst case scenario is to propose replacing a brand new piece of equipment for environmental reasons, right? So we need to be thinking about replacement cycles, but also even longer term than that are the cycles of the geological cycles that we're seeing unfold around climate and weather patterns and the mega drought here in the Southwest.
And maybe just to build a little bit on when you mentioned extreme weather, I think we've spent the last 20 years creating policy that's been very focused on mitigation strategies. And we haven't done it very well because we haven't really reduced our carbon footprint as a global economy. And so now we have two things that we have to manage concurrently. We have to manage mitigation and doing that a lot faster, and also adaptation, because we have absolutely accelerating extreme weather events happening that I think everyone has lived through. Wherever you were this summer, you were probably touched by it in some way. And that's putting more and more stress on all of our infrastructure and all of our buildings. And so I think that in the built environment, we're dealing with how do we deal with all these policies is set up for me to mitigate, and all these incentives and tax rebates that are absolutely amazing and transformational to the economy. But at the same time, if you've just put in tons of EV chargers in a subterranean basement and it floods, you have a whole new set of problems. And so we have to get really aggressive about how we're managing adaptation at the same time as mitigation.
Thanks, everybody. This next topic might sound boring, but it's exciting. One thing, what was really next for ESG is the goalposts keep moving about reporting demands and regulations, and everyone's working from a lot of draft documents. And I thought it could be maybe interesting to get into that, whether it's SBT or SEC or Scope 3. Rob, I know that you are dealing with it.
The alphabet soup of reporting. My background's in architecture and building science, and I never thought I was interested in carbon accounting at all, but by necessity I've had to become a carbon accountant to try and piece all this together. The challenge, and everybody I'm sure is aware of this, the challenge is You know, when we talk about scopes of emissions, my scope 1 and 2 is not necessarily your scope 1 and 2. Scope 3 varies depending on who you're talking to. It means completely different things to completely different people. There's 15 categories of scope 3, and how you quantify them and track them and report on them varies. SBTI has different regulations than others. So it's really challenging to piece all of this together. We're trying to do it in a thoughtful way. We're trying to use the way we collect data, the way we analyze that data. Sit on the standards committee for GRESB, the Global Real Estate Sustainability Benchmark. And part of that exercise is to try and get GRESB to serve the purpose of providing data in an ongoing way that helps to satisfy the reporting requirements of all of these different global frameworks that we're seeing. So there's a lot of emphasis trying to get some consistency there, but certainly we're in the infancy of reporting and what it means longer term. And it is a big challenge to piece it all together in a way that makes sense and that you can explain to your board, to your C-suite, and everybody else in the organization why we're asking for all this information, how we account for it, et cetera. So, lots to do.
Yeah, I think it's a really interesting time to be an ESG practitioner. I mean, there's obviously there's like this political tightrope that we talked about that we're all trying to gracefully navigate, but there's also, as you said, Mary, the goalposts keep moving, and the standards organizations like GRESB and others are as they evolve naturally. And it just so happens that I think a lot of the organizations are right at this moment going through their kind of pubescent journey from early stage organizations into more sophisticated organizations. And part of that's around regulation coming down from the SEC and organizations like the Greenhouse Gas Protocol evolving to meet that level of expectation. But part of it's just like the wave of interest from investors is pushing GRESB to be better, as it should, which is great. But for those of us who are trying to track the alphabet soup, it's a really hard time to understand what definitions you're using, certain definitions of net zero. There's a bunch, as you all probably know. They're all changing right now. And so things that a lot of organizations have committed to, now the ground is shifting under everyone's feet. And so I think we'll see right now and in the next 24 months, there will be, I think, a lot of change in what different organizations shake out and what pathways they end up taking.
Yeah, there's a lot in that question. I'm fairly bullish on the SEC passing something next month. Scope 3 is a big...
Next week.
Next week? Next week, okay. I had heard 2 days, but I thought it was October. Scope 3 is a big question mark. We had our goals validated by SBTI earlier in the year, and we've got a Scope 3 goal in there. So we have been and will continue to track and report on our Scope 3 emissions, regardless of whether it's included with what the SEC passes. We may be a little bit different than the most of the portfolios represented in the room, in the sense that we're following an asset-light strategy, and so we're operating many facilities many of which we used to own, but no longer own. And so our Scope 1 and 2 is still captured in our captured in our footprint, but we have a large workforce, and our Scope 3 is the majority of our footprint. I feel like we've been reporting on and managing our Scope 1 and 2 emissions for a while. Scope 3 is a real different story, and I keep saying that I feel like the data sources and the methodologies to calculate and the tools and the goals are all evolving in parallel, and so it's going to be really interesting. And I think as we have been doing engagement within the organization, it's been really interesting. Our conversations with our legal department, especially with our procurement team. So I think it's going to be really interesting to see how it evolves on Scope 3.
Do you want to share what your biggest Scope 3
Well, so it's not so, we're the largest operator of non-chain restaurants in the world, and so it's not surprising that it's food and beverage, and beef is a really big one. So you know, we're myself and my team are trying to become quickly experts on regenerative grazing and sustainable beef, which again, as an architect, I never thought I would be focusing on later in my career.
Yeah, and we, just to echo my point earlier, you know, same industry, but completely different versions of Scope 3. I don't have a beef problem. Not something I've ever considered or looked into, so it varies considerably just depending on the activities in your particular assets.
Yeah, Heather, how are you advising clients, and what are your thoughts here?
So I'll just say a little bit about what Fifth Wall is doing. So first, within our climate funds, we're very focused on how do we help companies scale that are working on avoided emissions in the first place, right? So some people are calling this Scope 4 or avoided emissions. So that in itself is a really interesting place to be. And at the same time, as asset managers, we are tracking our Scope 1, 2, and 3 emissions. And our biggest emissions, like most financial services people, is 3.15, right? So it's our financed emissions. And so it's super important that we are looking at what our portfolio companies are doing. And so we went through an exercise this year where we asked all of our climate tech portfolio companies to report to us, to just give us information about what their emissions are this year. And we'll be continuing to do that and expanding it out actually into our proptech funds. And, you know, going from the place where we believe that there is value creation in responsible business practices and understanding what your emissions footprint is, it's really helpful to have that information that actually we can then pass on to our LPs so that they have that information, right? So that they can work on what their portfolio is. And then just a last point on this goalpost moving, so much of what we're all doing is still voluntary and requested and not required. And so as much as that is frustrating, it's kind of like all we have to go on. And I still keep thinking we are still moving forward, though way too slowly, and we're in a better place than we were a few years ago, but we're not where we need to be.
Yeah, I think that I do think we might miss these days when we get the actual regulations, although it is a really positive thing for the industry. Thanks for that. Then shifting gears a little bit, love to hear about an innovation you're seeing or implementing that is exciting. I know when we talked about this in our prep thing, one of the things that came up was energy storage. One of the things, and remember I said exciting, was 24/7 carbon accounting. I'd love to hear from you guys, just anything that's at the top of your mind that you are excited about.
You know, I think a technology would be the expected answer for this question. So I'm going to go a different way. You know, I think two things. We've been having some really good luck with an internal approach that's not only data driven but also research driven in terms of understanding complex issues and doing it in a way that we're bringing our board and our C-suite along with us to establish kind of a foundational understanding of the issue. And out of that evolves kind of a self-evident strategy and a set of actions that because we've brought them along, we're getting good traction on. So we're beginning to apply that approach to a number of different issues. We really started with water. We wrote a water white paper, which there's a copy of on our website if you're interested. And that led to the development of a global water policy. We endorsed the CEO water mandate earlier this year. Our CEO, Bill Hornbuckle, did. And we developed a water training and was completed by over 6,000 managers in the company. So I think that we've had really good success with that. I'd also say just a focus on culture So I report to the Chief People, Inclusion, and Sustainability Officer. So having sustainability in HR and D&I and philanthropy and community engagement under one integrated leader has been great from a culture perspective. And I think in certain ways we're taking the S of ESG and leveraging that on the E. But also, when we think, to use my water example again, we've developed a framework with five pillars, and 2 of those are around culture and citizenship. And so really focusing beyond our direct operations. So we're the largest employer in the state of Nevada. So given that mantle, how can we use that to leverage impact beyond our direct operations?
Oh, thanks. Natalie, I want to hear what excites you, but Michael's comments also reminded me of something we were talking about before, was when you were saying how it's really amazing to see these principles and these issues of sustainability really integrated throughout the organization, namely the leasing people. I don't know if you wanted to tell the room about that a little bit.
Sure. I mean, we feel like we have such a different business model than so many organizations. Like in Ivanhoé, we're the opposite probably. We're like pretty small and focused and vertically integrated. And anyway, because our clients really care and customers really care about sustainability, our people do from the top to the bottom. And the tech that I can geek out about, that I'm really excited about right now, is in our studios portfolio. So we're a real estate company, office and studios. Within our studios business, we own a bunch of sound stages. The real estate, we also own a bunch of the production services that come with that, like over 1,000 trucks and trailers and other vehicles. And we have all these people in the field who are in our manufacturing facility, who are making trailers, who are so into how can we put solar on every inch of a trailer? Can we build awnings on the side of our trailers and pop them up with solar to add? How can we rip out the generators and stick batteries underneath? How can we, the mobile power plants that we rent as part of our fleet, how can we replace them with hydrogen generators? I mean, there's just all sorts of really cool innovation happening in the production services industry that's been very bottoms up and organic, which is always way more fun than the other way around. And honestly, and there's also just a ton of client demand, which is really fun. And you can get a real premium on these things, which makes everyone happy. So that's cool. And for me, that feels like that the momentum has really hit, and we're going to start seeing a turning point.
Great, thank you. I'm also sorry I called you Heather. I'm 55. Heather, sorry about that. Natalie, what do you think? Anything to add, Heather?
Sure. I could just say, maybe also to talk a little bit more about carbon accounting again. I think that's been such a top-down process from GFANS and UNPRI and all of these very kind of stodgy institutions that don't have very good tech. If anyone tried to just submit to UNPRI, you know what I'm talking about. And something that I'm super excited that fifthwall is part of is the Venture Climate Alliance. And so it's kind of taking all of these big public companies, asset owners, asset managers who have been told that they need to track their emissions, come up with a way to do that. And now the kind of one of the last pieces in that whole value chain process is the Venture Climate Alliance, where we're developing the template and the kind of questions to ask of early stage companies that are appropriate for early stage companies to be asking and answering, so that you're getting early stage companies much earlier in the process, instead of when they've already built up a whole series of systems within how they operate, where they operate, how they've built their facilities and what they're doing, and then trying to intervene a little bit earlier to understand that better before companies move into a place where they are ready to get acquired or to IPO, so that we can just help earlier on.
That's really amazing. So the buy-in starts really day one.
Now.
Love that. Rob, what about the investor perspective on what are you seeing that's interesting? Are things you're seeing that you're concerned about?
One of the things we've really tried to do in the last couple of years is the integration throughout the organization to ensure that everybody understands their role in how all of this works. Everybody's annual remuneration now is tied to a carbon target for Ivanhoé. So if we achieve it, we collectively all benefit from that. We have converted about $10 billion in corporate credit facilities to sustainability-linked loans that are tied to meeting specific KPIs. And if we don't achieve those, we're penalized in terms of the margin we pay. And if we do exceed them, we're rewarded financially. So we're really trying to integrate across all levels and all sort of areas where there's a financial piece of making sure that those are all tied to the overall objective of decarbonization, climate risk avoidance, all of those sorts of things. The other thing that we're seeing more of now at the investor level is really on the underwriting and the valuation piece of what all this means to an asset, both from the investment perspective of how do we actually quantify carbon through an investment, how do we quantify climate risk through an investment. And we've developed an internal process that is not cleverly named Green IRR, where all of our teams at the end of the year, when they report on returns for their respective portfolios, they also have to provide a matching return which they run through a green lens, where we put a price on carbon for all of the emissions related to those particular assets. And that allows us to see a carbon adjusted return that helps justify CapEx to overcome that potential impact. So in markets like New York, et cetera, where we've got real pricing or coming already, we'll use that number. But where we don't have carbon markets, we'll just use a standardized dollar figure. I think it's $100 per ton we currently use to try and establish what does this mean in terms of where these assets are going from a carbon performance perspective, and how does that ultimately potentially tie in to valuation, to liquidity. Can we sell this asset in a number of years? When's it potentially going to strand? Will there be a buyer for it at that particular time? So really trying to think differently in the financial model about how we have versus how we have historically done this. And I think that's going to see a lot of uptake in the coming years for sure.
That is super interesting. When you were saying before about compensation being tied to reaching these goals, is that just your team or is it the investment team?
No, that's the whole organization from the CEO down. It's every Ivanhoé employee has a multiplier in their bonus structure that's tied to our carbon objectives.
That's like a great blunt instrument. So people are really on board. I mean, they have to be, but was there resistance to that being put in, or is it really a firm-wide philosophy?
Our CEO, Natalie, she's drank the Kool-Aid years ago. She's a firm believer in everything that we're doing and really sort of drove that. So even if there was resistance, there wasn't really much of an option. So it all worked out fine, yeah.
Gotcha. Okay, well, we're at the 2-minute mark. And if, one thing I just wanted to ask everybody quickly, is there one thing you wanted to leave us with, where are you seeing pushback and where are you seeing progress today? Maybe I'll start with you, Heather, because you're next to me.
Sure. I think we're seeing progress in red states, and I think we're seeing pushback in red states. So I think we're seeing progress in red states because 2/3 of the clean energy programs that have been started from the 3 pieces of legislation that have passed are all in red states. And I think that we're also seeing pushback in those states, as I was saying earlier, because we've got 156 pieces of anti-ESG legislation that are sitting at the state level. Most of those are in red states.
Rob, what about you?
We used to be the first thing value engineered out of any potential project, and we are no longer value engineered out of most things, so I would say that's progress. What we do is critical to what Ivanhoé feels to the success of the organization, and that's a fundamental change, I think, over the last couple of years for sure.
That's interesting. We're yes and no to that. We have the sustainability initiatives have never really been value engineered out of our projects, but it is a much tougher market for us now than it was a year or 2 ago even. And so we are seeing pushback on some things, mostly in the form of deferred CapEx. But what that opens up for is creativity and things like creative financing initiatives that we honestly didn't feel like there was a interest in spending any time on when times were good. It was like, why spend time on something that's gonna, basically the equivalent of 5 cents a foot, and now every penny matters. So it's just shifted the focus from certain things to others.
Great. And we're seeing pushback in terms of being more rigorous, even more rigorous in terms of articulating the value of our initiatives given the economic conditions. And I'd say we're seeing progress on all of our initiatives that support our 2025 and 2030 goals.
Great to hear. All right, well, we're at time. Thank you so much for your attention, and thanks so much for all you do.